Hey everyone, thank you for coming to Signal. So I am the moderator today for today's panel. Very nice meeting you. My name is Eva. I lead our investments team at Caladan, and I would let our panelists to give a very quick introduction about who they are and what, which firm you work for.
Hello, my name is Ryan. One of the co-founder and partner Hash. Hash start from 2016. We are basically start from a venture fund, also prop fund investor, and we are quite like investing to not only infrastructure but more like application, DeFi, etc. And quite distributed to San Francisco, US, and Korea. We are all always thinking like connecting Western and Eastern, and also positioned as an ecosystem builder.
Hi guys, my name is Zaheer Ebtikar. I'm the founder of Split Capital. We focus on liquid markets in particular, and we also focus on high frequency trading as well.
Hey guys, so I'm Sanat and I'm the CIO of Monarq Asset Management. So we're a very classic hedge fund. We have two different funds. We have a market neutral USD fund, a market neutral Bitcoin fund, and we also have a market neutral, we also have a directional fund. So I guess I'll be representing the liquid side of things here.
Hi, I'm Richard Hodges. I run Ferro Capital. We run $100 million of volatility trading using options for hedge fund clients. We've just launched a small fund and we're in the process of launching two more.
Great. So, from purely Caladan's perspective, so we do a wide spectrum of, venture capital investments, liquid investments, and liquidity provisioning. So this year we have found ourselves doing sort of fewer venture investments and switching our focus more on the liquid side. So we'll be very curious to hear about what kind of sectors or narratives are you guys pursuing on the liquid side, or any tokens, not financial advice, but would love to hear about what you guys are looking at.
Yeah, maybe. So we also start from a venture fund, but end of last year we started to trade more as a liquid fund, and our identity is more like a venture. So we're not like doing a high frequency trading, but rather we investing like low valuation but high fundamental. We invest to the project. So early this year, obviously, Trump came in, the whole valuation drew down, and we jump in like a few tokens, and especially what we are really interested in is of course DeFi, but also IP. So for example, obviously Pengu was one of the successful IP meme coins. So we jump in that field, and also Story Protocol is our first check we are first check investor of them. So as you know, Korea is really good at a K-pop, K-drama. Also, we believe eventually this IP can be integrated to a blockchain world. So we will keep pushing hard for that. And other thing is obviously the hyperliquid is making so much liquidity. So we're looking at the hype EVM. And we're jumping into that token as a liquid ledger.
For us, it's kind of a mix of both. So we take extremely highly concentrated bets within the liquid market. Some of you guys may know that we're very big on hyperliquid or plasma now, but that's basically all we focus on. The universe of investable assets within crypto is very, very, very small, and the universe of being able to make money on those assets is even smaller. And so, I see Jason Cam in the crowd here, who very much shares the same view. But there's not really a lot of diversification that needs to happen necessarily. And almost all of the portfolio returns happen within a group of 5 assets across a year. And then on the other end of the spectrum, we do a lot of high frequency trading where, that's much more alpha generation, right? So we take that barbell approach. I think right when you get in between, when you focus too much on broad diversification, that's when you get killed in crypto. That's been our kind of bread and butter, and what we think has been very valuable.
So not financial advice, right? So as a hedge fund, and as I mentioned, we have two different parts. We have the market neutral side and we have the directional side. On the market neutral side, our alpha comes from primarily doing a lot of yield farming. So we meet with founders very much like the way a VC would meet with a founder, and we're evaluating the project. But what we're doing is we're actually depositing into their smart contract and yield farming the rewards. And then one of the decisions is then, do you just hold on to the tokens? Do we sell the tokens, right? But, and we'll go into this in more detail, Eva, later, but one of the nice things is that when we get tokens from the protocol, they're usually not locked, unlike what a VC would get. So we spend a lot of time on that. On the directional side, so the 2 or 3 areas we are very excited about overall, one, I think, is the real world asset side. And within that specifically, I think, as you guys all know, the hot stuff right now is AI in real world assets. So this is USD AI. So we've been very active in that space. They just raised $500 million. And if you guys came in during that window, then you get the chance to buy their tokens. So it's definitely very interesting. We've been also very active, I think, on the perp side. With Hype, so we're very bullish on Hype and Hyperliquid. Also have been looking at the real world asset side from the tokenization perspective. So companies like Centrifuge, etc. We are very bullish. We think Centrifuge is undervalued compared to their peers like Ondo, etc. So that's just on the liquid side.
Great.
So we trade volatility using options. We make money by pricing risk more correctly than the market, which is a bold claim, but actually it turns out that very often fund managers are incentivized to misprice risk by their clients, AI being one area of that. So we trade $100 million of vol on Bitcoin options. We're also trading TradFi options in order to generate yield for Bitcoin or yield in Bitcoin. I've had some discussions recently with some family offices comparing and contrasting VC style investments versus liquid investments, which is kind of what this panel's about. And so I think that raises some interesting questions around the risk premium or the time premium involved in illiquid investments, which I guess we'll come to.
Great. So I think next the format will be I'll just be asking 1 or 2 people at most, just so that we can get through more topics. So the first question that I have, maybe that's better for Ryan, because for Hash, you guys have both a VC arm and then also a liquid arm. So do you think now that you're spending more time on the liquid side, by avoiding illiquidity, you are actually getting more interesting or healthier risk-adjusted profile? Or how do you think about by avoiding illiquidity, you're also potentially missing out on some of the higher return, like locked venture deals?
Yeah, obviously now like a VC encounter very difficulty because all narratives are gone, and just like also the listing process is getting delayed. So most of VC when they get the liquidity already, the market maker and the KOL, they already get the token and they sell in the market. Once we get the token, then token drop to maybe almost 0. So that's why already a lot of VC deployed the money last 3-4 years, but now they're changing their position to be more liquid venture, and also maybe existing project they already listed on a major exchange like a Binance, Upbit, Coinbase. If the token price is now undervalued and there's better position to offer to liquid venture, then I think this is kind of bilateral deal between these two. So the liquidity perspective, I think VC I think they try to provide the now more value on the liquid side rather than just making ecosystem side, and connecting the market maker and exchanges to the deal, the project. That is a new value proposition as a VC.
Do you guys have a view on what kind of return threshold you're pursuing? If let's say VCs are pursuing a 10x on the liquid side, how are you thinking about risk reward and return threshold?
Yeah, we don't really have a return threshold. Our investors broadly very much kind of view markets in a similar way that I do, which is very much path dependent. In the world where Bitcoin does well, then on average, the rest of the market will do okay as well, and vice versa. So we don't really have a necessary return threshold. It's probably different for Sanat. It's just a very different ball game. But we like the vol. We enjoy that part of the market, and I think as soon as we try to get rid of that too much, in my own perspective, then I think being in this industry doesn't make as much sense for us.
So can I just quickly go back to the previous topic on liquid funds versus VC, and then we'll talk about the wall. So it's right now, I think, one of the hardest times to raise a venture capital fund in crypto, right? And part of that, I think, is, but if you've already raised a fund, you're actually sitting in a very interesting spot, right? Because what you can do is you can actually deploy into liquid markets as well. You don't have to deploy into liquid markets. For someone like us, we only have a liquid fund, so we can only do something that's much more short term. And I'll just give the quick example. So Paradigm, I don't know if there's anyone from Paradigm here. So Paradigm, the venture capital fund, famously during the 2018 downturn, so their VC fund, what they did was they called all their capital from their investors. And so investors were like, wow, why are you calling? Usually I'd usually pay all this over 3 years. Now you're calling all of it right away. And they deployed all of that into Bitcoin and Ethereum. And in some ways, it was still one of the greatest crypto fund trades in history, right? Because back then, Bitcoin came down to like $3,000 and Ethereum was at like $85 or something. So if you are a VC fund that's already raised money, you have, just literally this incredible universe, and you just have to kind of wait for these market dislocations, in my opinion. So, but at the same time, if you're trying to raise a new VC fund, it's a lot harder because the current meta is that you invest in a project, you have a 3-year lockup, right? You have a 1-year cliff after TGE, and then you have 2 years through vesting after that. Versus someone like us, we are a market neutral fund. We go to the same protocol, right, that Ryan would go into. I would go into the same protocol. I deposit into the smart contract, and we earn tokens, and the tokens are not locked, right? So that's the difference.
So as I mentioned, I've been thinking recently about what is the price for locking up your funds. In VC world, in crypto, maybe it's a year or 2 years, and in TradFi, it's 5-7 years. I think at the moment, given that the world is at levels of leverage and exuberance and criminality that I've not seen since 1999, plus we have extremely toxic partisan politics being played out in the leader of the free world, the USA, that premium should be very high. So in actual fact, at the moment, if I had to wait for 5 years for a payoff, then I'd want something like 10,000x, because the world will have changed, guaranteed, by the time I get there. So at the moment, I think I'm favoring liquid assets quite heavily.
Yeah, so specific numbers, I think, so if you look at traditional markets, venture capital top quartile performance is like 25-30% IRR, like 3.5x in 10 years, right? And the S&P is yielding about 13-14%, which is incredible. But so you're getting a 12% to 14% premium on the S&P 500 for being illiquid. In crypto, I think most firms haven't been around for that entire 10-year cycle, so it's a bit hard to measure. But yeah, you'd want to be getting like a 1,000% IRR at least for locking up your fund in a venture capital 7-8 year horizon. And then obviously for us, the challenge is we get measured against Bitcoin, right? So as a liquid fund, you have to beat Bitcoin, which is not that easy to do. It sounds very easy, but it's not that easy.
Yep. And one interesting observation just by listening to the conversations is even within liquid funds, it sounds like you guys have both some short-term plays versus long-term plays. So how do you sort of balance the sort of long-term conviction versus the temptation of like chasing short-term dislocations, and how much of your book is actually, long-term bets as opposed to short-term bets? Maybe that's a better question for the two of you.
Yeah, I think this is something I've done over the years where it's like you pivot between going long-term conviction and short-term conviction. It really, you have to make your conviction first on what you think the duration of the market cycle will be. Very difficult thing to do. There's no right answer. And then from there, you kind of now, backward derive what you think the best kind of portfolio will look like. And I think what we've ended up realizing is that on a long enough time horizon, the best assets in crypto will continuously win. And that's why you're seeing so much concentration within the top, assets within crypto, right? If you held nothing but Bitcoin and Hyperliquid, which has been the consensus portfolio for over a year now, you would have outperformed everyone, right? And then I look at my traders and I'm like, well, why do we own all this dog shit within the portfolio when we could have just held those two things that we've been very convicted on the whole time through? I think as soon as you start trading too much, you kind of burn yourself, because these wonderful delights of trading short-term gains on altcoins look very attractive, but in reality, they're not real. The market isn't as liquid as people think. The market of liquid assets is very, very small in crypto. So if you even have like 20 million bucks, 30 million bucks behind a few names, you'll realize very quickly that you become the market. So that really drives a lot of our short-term, long-term thinking. I think it's also a massive kind of, we overfunded crypto in 2021. Now we have to deal with the consequences across 3 to 4 years. And part of that is also that most of the assets that we ended up kind of now owning as an industry and really liking are the only ones that actually generate any value. So revenue meta, whatever you want to call it, real world assets. People love stable coins, right? I do. But all of this stuff comes out of the fact that most of the things that we funded in 2021 with big venture rounds just didn't work. They're all zeros. And now we have to kind of go back to a baseline of, well, something has to work. And then everyone starts chasing that same thing. Hyperliquid went from, liquid $7 in April to $58 within 4 or 5 months. Pretty incredible returns, right? So that's kind of how we think about it. Sorry, I went on for a bit.
Sure. So I guess another topic that I have, I think that's probably, yes. Do you have a, right?
So I think that depending on the sector, would be a little bit different. For example, like I think VC can endure long term, but like liquid venture, they're chasing like a short term return. For example, like the sector is like robotics. Like a founder, to make a result, they have to spend like at least 3 to 5 years, and the VC should be appropriate. But if it's DeFi or exchange, the right away they launch the product, they can make a revenue. Hyperliquid is one of the example. So you can show the TVL and revenue, and right away the investors and retail can calculate how much like a value would be the right value with these metrics. So I think this type of product should be fit to short-term investors. So I think depending on the sector and product, they'll be divided.
And I think just talking about liquid funds, I'm sure people in the audience understand this, but there's actually 2 ways to run a liquid fund, right? And 2 ways to invest in a token. And this is again the classic market neutral versus directional. So you could buy the token, right? And you're making an assumption on valuations, and you're making an assumption how it's going to go up, etc. Or you could farm the token, right? And where what you're doing is you're going in and typically depositing USDC or stables into a pool, and you're earning the token as a reward. And obviously the difference is just the quantum that you would get. And what we've found is so we run both funds, right? We run both a market neutral book and a directional book. And many times the answer actually is in the farming side, because and farming is not the right term, but for example, if you look at Plasma, right? Plasma was one of the best investments / trades, depending on what you call it, in the last 2 or 3 months. So you could have gone and deposited $4 or $5 million into the Plasma pool. And what you got is you got the right to buy the Plasma tokens at a 500 million FDV. And initially, a lot of people are like, wow, that sounds really high. But today, Plasma, famously enough, Plasma token did the TGE last week. and it's now trading at a 15 billion valuation. So you're literally up, what is that, like 20x, right? And you didn't take a directional bet, right? You were, it's a lot more than 20x, yeah, 30x actually, yeah. So we're looking for, in both our funds, right, we're looking for those kind of these asymmetric opportunities where worst case is you're depositing money and you earn some yield, right? And the best case is, on top of that yield, you got this token, which is, just skyrocketed.
Yeah, like convertible bond.
Convertible bond, yeah,
I
or
want to say
option.
I want to say one thing really quickly against Sanat's point. I disagree only because I think something like plasma or hyperliquid is so secluded from the broader market that there has not been anything like these two.
You're saying it's a one-off.
These are one-offs that are generational, and the companies and those projects took that stance that it is better that they airdrop the product at a very cheap val or give the right to buy at a very cheap val, and these things won't exist in perpetuity. And the other part of it is also that when any sort of farming operation is done, I mean, Caladan is very good at this as well. It is 100% correlated to asset prices doing well. So in my view, I mean, I worked, at Ledger Prime 3 years ago at a market neutral fund, which is also where, the Monarq team actually comes from. So my entire view is, oh my God, like I'm taking the same amount of risk being delta neutral. I should just go insanely long because there's no other option, to be honest. So that was kind of my view, unless it's 100% uncorrelated, right? And then you could get there with like, a centralized exchange arb, DeFi arb, whatever you want to call it. But this is why there's all of these varying opinions on this panel. So,
Yeah, I think we generally take the view that, these farming for tokens is similar to doing a venture deal, but you're taking way less risk because you're not really risking much of your principal. But you probably also need a small segment of your portfolio that's directional, just to diversify your portfolio. So the next question is for Robert. So we know there's more and more interest from TradFi coming into crypto. Do you think over time, like even for delta neutral, like hedge fund in crypto, like the return is going to normalize to TradFi level returns? And how have you seen your investor base change over time? Yeah.
So there's been interest in crypto from TradFi for the past 2 years, and we're seeing that interest materializing as it works through the investment committees and so on. They're now starting to allocate, and it's a good thing that there are things like ETFs because we need the liquidity to absorb the amount of capital that wants to come. So whereas in crypto, when talking to crypto allocators, I have to have discussions about whether they're going to allocate $1 million or 2 or 5. Last week, I had a discussion with a hedge fund in the US who wanted to do a trial allocation of 50 million and didn't want to speak to anyone who couldn't take 200 million. I think that's going to be the new normal, and we're going to have to find ways to. So I think whatever people have been doing to generate yield for the past up until now will go away because there just isn't the capacity for it, and we'll have to go back to. We're going back to the TradFi markets to generate yield in order to buy Bitcoin.
Do we have any questions from the audience? Okay, great. And thank you so much for your time, and thank you, our panelists.